Welcome to the second session that it examines the U.S. government responses to the coronavirus. And this section will focus on cooperation and conflict between the federal and state governments. In fact, it will focus a little bit more on the cooperation angle. We've seen some about the conflict. There certainly has been some conflict, primarily high visible conflict between the president and a number of governors about assistance. There's been some questioning as to who has the power to do what in closing things down and opening up the economy across the United States. But we're going to focus mostly on how the federal government and state governments cooperate in this, which is called a concurrent power. So let's start with an examination of who does what when it comes to this issue. So when we ask ourselves the question, who's responsible for addressing COVID-19, this is what we would call a concurrent power within the American constitutional system. In other words, there are certain aspects of dealing with the coronavirus which are delegated to the national government and certain that are delegated to the state governments and their local governments, which are under their control. So the president has the ability to be able to shut down the borders and test people as they come into ports of entry, whether they're airports or ports, and also has the power through the Commerce Clause to be able to regulate commerce between states. So for example, it would probably be illegal for one state to stop all people coming from another state from coming into their states vis-a-vis the Commerce Clause. The second big thing, and this is in the area really of cooperative federalism, is the Centers for Disease Control has the ability to be able to assist states in dealing with problems of viruses and other pandemic issues that cross state lines. And the CDC then is the primary liaison between the federal government and state and local governments as they try to deal with the COVID-19 crisis. And then finally, the federal government, unlike the state governments, can run unlimited deficits, and as a consequence of its broad taxing power, has the ability to be able to provide funding to state and local governments in times of emergency. And this is certainly one of those cases in which state and local governments have needed money, and we'll examine a little bit more about what the CARES Act gave to the state and local governments. Now, what about the other side of the argument about the state's powers to be able to deal with this? Well, the states have what are called these reserve powers, which are the police, part of the reserve powers of the police powers. In other words, they have the ability to be able to regulate the health and safety of residents of their states. What this means is that really kind of the quarantining power, the ability to shut down businesses, the ability to shut down schools, and all of the types of activities resides under the police power in the United States, which gives governors an extraordinary amount of power to be able to deal with this COVID-19 pandemic. Now, what we've seen here is, we've seen President Trump shut down borders early on with China, with Canada, with Mexico, with Europe, and various other areas around the world in an effort to be able to prevent the coronavirus from being transported from other nations into the United States. The CDC itself has been a very cooperative force here and works very instrumentally with state and local health departments, mainly by providing guidance because of its expertise and its testing. So when we take a look at most state health departments and most governors' actions in dealing with the pandemic, what we've seen is they rely very heavily on advice from the CDC as to how to social distance, as to how to prevent the spread of this virus. And then more recently, the CDC has focused on guidelines that help states reopen, again, based on the science that they have an institution in that they basically control in the U.S. They are also responsible for giving the testing kits over to the state governments and the state health departments, and that was somewhat of a problem at the beginning of the pandemic, although that in most cases has been satisfied at this point. Now, the states. The governors, most states, although not all states, about 80% of states have had some form of a stay-at-home order from their governor. This is again under the police powers to be able to regulate health and safety. So in Pennsylvania, President Wolf issued a stay-at-home order, and he also is using the criteria of how we get out of that stay-at-home order through a kind of stoplight system of red, orange, yellow, and green, and different counties under the Wolf plan as their coronaviruses recede, again, using CDC guidance, has opened up more counties across the state, starting mostly with Western Pennsylvania and now moving into the East, where by July 4th, most states, most areas of the state probably will be in the green section. This is going on all around the country, where the governors have used these stay-at-home orders under their police powers. So there's a lot of cooperation here. There has been some conflict. States, particularly New York State, believes that more help could be coming with testing and with ventilators from the federal government. They've actually received help, particularly with the ventilators, from other states as opposed from the federal government. President Trump basically initially left all these stay-at-home orders up to the governors, saying that it was their responsibility, which constitutionally it is. But then as we drug on into April, the president basically said that he had the ability, the constitutional ability, to be able to lift those stay-at-home orders and to order people back to work, but then realized he did not have the constitutional authority to do that. We see the tension there on these issues playing out in real time between state and local governments and the federal government. But again, this is a concurrent power. Now, one of the big things that we see when we examine the federal government's taxing power is its ability to be able to help out state and local governments in times of economic stress. And this is certainly one of those times. So we've seen the largest stimulus program in American history, over $2 trillion for the Coronavirus Aid, Relief, and Economic Security Act, the CARES Act. Our economists here at Widener University are going to talk more about the overall gist of what the CARES Act is and what it does. But I want to just highlight a couple of things related to state and local government, because the backstopping of state and local governments is enormously important for the state and local governments to be able to function during an economic crisis. So what we see is that of that $2 trillion, at least about $340 billion of that is going to state and local governments to help them deal with the crisis. And we'll take a look at specific things in a couple of minutes. But a lot of that has to do with just helping the state and local governments with their responses to the public health crisis itself. Now, one of the biggest things that's helping support the economy during this economic downturn is the federal government in the CARES Act basically saying that it would increase the amount of payments for unemployment insurance for extending them from the usual 18 to 26 weeks to 39 weeks, and to adding on an additional $600 onto each state's benefits. Now, this is very important. These programs are run by the states, and states determine the amount of payments and the length of the benefits. Typically, that would be about a half a year or 26 weeks. So in Pennsylvania, the minimum that you can receive on unemployment insurance is $76 a week, and the maximum is $580. And depending on where you're at, it ranges between 18 and 26 weeks. So this is very important. This is additional money on top of what the state would give out with unemployment insurance that is helping people keep up with their bills, helping them make payments, and helping keep the economy afloat while we're in this difficult time. Now, here's the problem. What happens is with these unemployment trust funds is that state governments generally build up their reserves in good economic times so that they have money once we get into a bad economic time. Now, the problem that we've seen is many states have finally dug themselves out of the hole that they faced during the Great Recession and finally gotten up to where they now have some reserves that they're able to use in unemployment insurance. But there isn't a lot of money in a lot of states. So if you take a look here, taking a look at some of our bigger states in the country, the reserves California, as of April, only had 4 weeks of reserves to pay its unemployment benefits. New York only had 5 weeks. Texas only had 6 weeks of reserves. And in Pennsylvania, we only had 11 weeks. So what's going to happen to these unemployment benefits? Well, once those trust funds for each state run out of money, the federal government will loan the money, usually at no interest, to the state governments so that they continue their unemployment payouts until the end of the economic crisis. And that means that they're borrowing money that they need to pay back in the future. There's some discussion now that maybe they should just let the states borrow the money and not have to pay it back in the future, but Congress has not been able to decide on that. But this is certainly a huge interest for the state governments, and they're backstopped by the federal government. What about the benefits for state and local governments under the CARES Act? Other than the unemployment insurance, there are a couple of really big things. First is $150 billion that goes to the COVID-19, it's called the COVID-19 Relief Fund. These are funds that go directly to help state and local government with costs related directly to public health. Right? In other words, trying to stop the pandemic within the borders of each state. Some of this is allocated to local governments, typically county governments, and some of it's given to the states. There's probably, unless you are interested in finance, nothing more boring than raising the interest of a municipal bonds. But they are very, very important to keeping the economy moving for state and local governments who need to borrow money to invest in their infrastructure. And there was some concern that people would not buy bonds that were being sold by state and local governments, or typically called municipal bonds. So in the CARES Act, the Treasury Department and the Federal Reserve were giving the ability to be able to buy up to $500 billion worth of state and local bonds, as well as private bonds as well, to keep them liquid, to give them the ability to be able to borrow money in order to keep projects going at the state and local level, and that's extraordinarily important. Education's also been important. $30 billion, almost $31 billion has gone through K through 12 and higher education programs. For the K through 12, the focus has really been on dealing with closing down schools, retrofitting them for the future, also making sure that you can move into online capacity and have the tools to have your students be able to learn from remote sites. With higher education, it's helped out a bit with student loans, and also helping students with payouts through their universities that have been adversely affected by COVID-19. And then there are a whole bunch of other hosts of issues that are associated with this. So for example, transit systems for the most part in major metropolitan areas have been forced to shut down or have very limited service. Oftentimes, trains, subways have shut down, and the only thing left are buses, and they should be used only for extreme and important services. So the federal government gave $25 billion to these transit systems to help them because the transit systems are shut down, but to also keep them working so that essential workers can take buses and so forth to get to the places where they need. Now, there are all kinds of other things. We could spend an hour talking about the different types of funding. There are funding for homeless people, there are funding for nursing homes, there are funding for basically a wide range of things related to food programs like SNAP. And there are smaller pockets of money all around here that are going to things that are either state and local government related, or oftentimes are partnerships between state and local government and private entities. But suffice it to say that without this money, state and local governments would be in very serious problems. However, they're not out of the woods yet. And here's the problem. The COVID-19 money that came out of the CARES program is essentially only targeted directly at costs related to dealing with the pandemic at this point in time. However, what we see is that in times when people don't spend, which is generally during recessions, state sales tax, state tax collections drop. Why? One, there are more unemployed people out there, so the income taxes don't come in from the state government. Second of all, people don't buy things during a recession, so sales taxes go down. So you can see here that tax collections tend to go down in these recessions that we've had in recent years. Many states have a rainy day fund, but there isn't, a lot of money left over in that. And what you'll see here is that we could be facing some of the worst budget shortfalls in American history, at least in absolute terms, as a consequence of COVID-19. So looking at all states in the 2021 fiscal year, which for most states starts on July 1st and ends on June 30th, states are projected to have losses of $290 billion, right? So say, all right, well, the federal government just borrowed $2.2 trillion basically to pay for the CARES Act. Why don't states just do that? Well, 49 of the 50 states have balanced budget provisions within their constitutions, which means that they can only spend what they bring in. And what that means is that during a recession, what we see happen is that state governments and local governments, in order to be able to balance their budget, will do one of two things: cut services or raise taxes, neither of which are palatable to people that want to get reelected. So one of the big concerns that we're seeing right now is that a lot of local governments and state governments are cutting back on their capital projects, investing in infrastructure, investing in roads and things like that as a way to balance their budget. These are things that help the economy, and they're very important to us being able to emerge from the recession. Now, state and local governments have asked the federal government for more money. They want $500 billion more from the federal government, basically to given directly to them to help them out over the next 2 years to deal with their budget shortfalls. So the National Governors Association, the National League of Cities, the U.S. Conference of Mayors, the National Conference of State Legislatures, the National Association of Counties, all these public officials have been asking for this. And the Federal Reserve Chairman Jeremy Powell just last week said basically, if state and local governments are hit really hard and they have to cut spending, we're really going to see a steeper economic decline than we think that we're going to have. Now, here's the problem. As we'll see in segment or session 3 of this discussion of COVID-19 in the United States, partisanship really has a big deal as to what people will support and what they won't support. And essentially, Republicans in Congress we're not going to bail out the states and the local governments, seeing that large local governments are usually run by Democrats. They don't want to give the additional $500 billion in aid. They want the states and local governments to come up with it on their own. Democrats in Congress are more reliable in looking forward to this larger payout. But we really have to wait and see how this progresses. It doesn't look like something that's going to happen in the near future. Let me leave you with a slight note here let's just say how bad it could have been. So you've heard a bit about plagues in American history earlier on. If we go back and take a look at the yellow fever as it spread through the United States in 1793, we can use a case study here of our state, Pennsylvania, and particularly Philadelphia, as to how it dealt with the epidemic in 1793 yellow fever. If you remember, probably not personally, but if you remember from your history textbooks, in 1793, Philadelphia was the capital of the United States, the capital of Pennsylvania, and also its own city. And what we saw happen there was that the federal government fled rather than deal with the yellow fever problem. The state government hightailed it out of Philadelphia as well and pretty much abandoned the city. And the city government of Philadelphia pretty much also abandoned the city as well. And what we saw was it was left up to a local committee of citizens just to deal with the problem. So luckily, we've seen a little bit more cooperation and a little bit more activity among the national government, state government, and local governments in this pandemic than we did in 1793. So I guess we can say it could be worse.